We're going to do the weekly market review for the week that just ended in August 9th. So before we start looking at the markets, what we want to do is take a look at what's ahead for us this upcoming week. And the major thing that is happening is on Friday, August 16th. That's the monthly expirations. So people don't realize how important these expirations are, because what happens is institutions have to go and reallocate all their money. Everything that is coming off this Friday, they've got to reallocate it and decide if they're going to stay in the same positions or if they're going to modify their positions, if they're going to stay in the same stocks, go to different stocks, and everything has to happen by Thursday or Friday. So what we see is the potential for a lot of shifts in money. And there is a lot of kind of unclarity inside the markets until we actually get that expiration. So I think last week I gave an example of this UHS, where we have a huge amount of expiring on Friday, August 16th, and after that, there's almost no positioning anywhere else. So once this spike goes away, all you see is a flat level playing field, which means that we can't look ahead. We have no idea what the players inside UHS are going to do, United Health Services. And so it's not until after Friday where they roll all of these do we get to see where they're going to position themselves, or if they even roll, they might just take that money and go elsewhere, in which case that would be a big indicator to us that perhaps healthcare is not where big money wants to be. So it is very difficult to take positions this week. And in fact, I might recommend, depending on what we see, if we can't get a good look into the future and how things are being positioned, then you have no edge. Everything's just random. And then that puts us into gambling territory, which is what we definitely do not want to do. So we'll take a look at the overall big picture of everything, how everything is moving, and then we will decide whether to make modifications to our portfolio based on that. So first, we'll start broad. We'll look at our dollar. You can see that our dollar came down pretty hard over here. Starting over here, that was the Japanese Bank of Japan decision that they're going to start increasing rates. So we are definitely in a downward. We definitely broke this channel that we were drawing over here, and we are in a downwards trend in the value of the dollar. So dollar less valuable will relieve the inflationary concern. Actually, sorry. Dollar less valuable increases the inflationary concerns. And this is overall long-term not great in terms of having rate cuts from the Fed. But one of the concerns with this Japanese carry trade was that not only was Japan moving upwards, the market is expecting that there's going to be rate cuts beginning in the United States. Well, rate cuts will not begin in the United States unless there is strong evidence of either a recovery in inflation or a breakdown in the U.S. economy. So far, we haven't gotten either one of those. I know the market is saying that we have a 100% chance of a rate cut and almost a 50% chance of a 50 basis point rate cut in September right now. But I'm going to go out on a limb and actually put myself out. Normally, I don't like to do this, but I'm going to take a strong position that we are not going to get rate cuts in September. I talked about this a little bit throughout the week, how the Fed is political and is beholden to the markets, but they don't want to appear that way. They don't want to be blatant about it, and they don't want to just kind of wave it in front of the public's face that they're doing that. So a rate cut in September will both be very widely perceived and clearly perceived as reacting to the markets and as being political. So earlier, when people in the news were talking about a 50 basis point emergency rate cut, I said that's not going to happen. Well, I'm saying the same thing to a September rate cut. as well. So uh, in any case, it's just not at this. If they were going to cut rates, they should have done it a long time ago instead of waiting this long. This is sort of like the inflation is transitory. Inflation is transitory. They waited like 1 or 2 years before they really realized and acknowledged that inflation was in fact not transitory. And now we're kind of in this high rate environment for a little too long, and it's creating a very strong possibility of recession later on. Not right now, but later on in 2025. In any case, this dollar is down. What will prevent us from keep on going down? So this drop, we can say this drop right here. Where's this drop? 25th. When was the announcement? Bank of Japan announces rate hikes. Let's see what date that was. July 31st. Okay. So that was this one right here. Okay. So we came down, we were going sideways along the MA50. Bank of Japan announces, then we go down. And then we're having a little bit of a recovery. So we need to take an institutional perspective and say, if I am an institution, why did this happen? Because remember, this was a sharp panic sell-off that started with the institutions and bled into the retail. And then what happened right here? What did I say would happen? I said that this is going to be a field day for institutions. They're going to go on a buying spree. And we got news out of JP Morgan later on that on this day, retail traders sold 14 billion. I think it was 14. Yeah, 14 billion in stocks, and institutions bought 1 billion in stocks. They're having a field day. They're having the kid in the candy store moment, and they're buying things up, and we're then all throughout the week. So why? Why does this happen? Why did the institutions panic, and then why did they go on a buying spree right here? And what is going to be very important is, what did they go on a buying spree for? So institutions panic. We see VIX spike through to COVID and financial crisis levels on this day, all the way up here in the 60s, just crazy, crazy high. We don't see that until COVID over here, and then not again until the financial crisis. So why? Were we in a crisis mode? This is nothing like COVID, nothing like the 2008 financial crisis. So why? Why is this? Why did we get that? Well, if I am an institution, and for years I've been borrowing from Japan at a 0 or negative interest rate, and then taking that cash and reinvesting it in the US in particular at very high interest rates or in high yield in the stock market, and suddenly the Bank of Japan surprises me and starts to take that trade away. Well, what happens then is I need to start paying. Number one, the way that I borrow from Japan is that I is always through bonds. Okay? So I'm able to take money from Japan at a certain rate and go ahead and reinvest that into the US. So I have to, if I'm borrowing money from Japan, I have to pay that back. I have monthly payments. But when it's at 0%, monthly payments isn't that big of a deal. If it's at -%, it's even less of a big of a deal because I'm actually making money every month. But the point is that I have cash outlay. I still have to pay principal. So I have a cash outlay to Japan. And then two things happen at the same time. Suddenly, I cannot borrow at a 0% interest rate anymore. And my dollar goes way down in value against the Japanese yen, I have to take my US dollars and convert them back into Japanese yen in order to pay off the Bank of Japan. So I'm losing a lot of money in this US dollar Japan trade. So a huge amount of money lost right here if I have to convert back to Japanese yen and pay off the Bank of Japan. So what do I do when it looks like I'm going to lose a lot of money? I start to unwind my trade. I want to reduce my exposure to that trade. So we start selling. What do I sell? I sell the assets that I bought using the money I borrowed from the Bank of Japan. And for the last 2 years, this huge write-up and this huge write-up right here was AI and semiconductor stocks. So what I'm doing here is I'm very, very much almost in a panic, but I'm scrambling to offload my AI and tech and SMH, my semiconductor type of stocks, in order to generate cash, in order to pay off Bank of Japan and get rid of my loans from the Bank of Japan, or at least reduce my loans. So when we saw this sell-off right here from August 1st down into August 5th, yeah, 1st into 5th. If I look at SMH, what happened? 1st through 5th, huge sell-off right here. If I look at XLK, huge sell-off right here. But what if I look at XLP? 1st through 5th. Nothing. My first, I was here. 5th, I was right here. Almost nothing. If I look at XLU, 1st to 5th, nothing. If I look at XLV, 1st through 5th, okay, a little bit more significant, but nothing like what we saw in tech. Look at XLI. Okay, this is significant. XLB, this is significant. Not as significant as XLK and SMH, but still significant. So what does that tell me? That tells me that we were selling the assets that we bought with this borrowed money in order to unwind, at least partially, that Japanese carry trade. And then I said, what are we going to do? I said, well, we sell things off, we have a whole bunch of cash. If I'm an institution, I don't want to be in a whole bunch of cash unless I'm in crisis mode. And this was not a crisis. We are at close to all-time highs. We're not in a bear market. We are still looking very good. We are expecting rate cuts from the United States. That's stimulus to the markets. So I'm going to be that kid in the candy store and I'm going to be buying things like crazy. What am I buying? I'm buying the things that retail traders are dumping, other than the AI and SMH stocks. So we started to see that pickup. Let's just see what happened from on Monday to Tuesday through Friday. So in the last week. So we'll go back to that XLK. Okay. Recovery, but not a huge recovery. I'll look at XLU, flat, sideways. XLP, it's flat, sideways, very gentle upward slope. XLV, okay, nice jump, nice huge recovery right here. And then, but let's look in particular at the SMH. So just a little baby recovery into a VWAP right here, which is not great news. So what does that mean from an institutional perspective? I was buying things, but I was buying in the defensive sectors. I sold in the speculative. I bought in the defensive. We watched the markets come back up to here. If I am a large institution and I've been putting on this Japanese carry trade for years, there's no way I can unwind it in a single day or even just 2 days, 1 or 3 days. It's not going to happen. I can't unwind years and years worth of trades in 3 days without creating a huge panic sell-off. So I do what I can over here. And then what? I don't want to keep selling at this level because one, I don't want to create a market panic, but two, I don't want to lose money. I'm losing money down to here. If I keep on selling off, I'm going to lose more and more money. So what do institutions do? They wait. They wait for this to come back up to another favorable level, and then they'll start selling again. And they'll keep on doing it until they've unwound as much of their carry trade as they've wanted to. So this was just this first one. So the expectation is that this is going to be allowed to float back up so that markets don't panic. And then when we hit a critical level, for example, maybe the MA50 or the EMA20, I've drawn these K0 and G0 lines as well as possible points to where we might float up to. And then we're going to sell it off again. Where are we going to sell it off to? I drew this magnet point, or it could be the VWAP again, or it could be the MA200. I'm going to sell it off again. Because why? I still need to unwind my trade, my Japanese carry trade. There's no way I got enough done in just 3 days. So we're going to do it again. And then it's going to float back up, and then we're going to do it again. And it'll float back up, and we're going to do it again, and do it again, and do it again, until all of the institutions have unwound enough of their trade. What does that mean? That means chop sideways. A large range, high volatility chop sideways. We have elevated VIX. We're at 20. Remember, we were just at 12, 13, just a week before that, a couple weeks before that. So this is an elevated VIX still. Even though we've come down off the crazy highs, we're still very high, very, very high. Where's the last time we saw 20? It was this market pullback in the S&P 500 earlier this year, the first pullback that we had. Then we saw it again in October. What was October? Okay, so we had this March, April pullback, and then we had it in October. Right here. So this is what we expect. Pullback, pullback, pullback. But we have a bottom now because the institutions, they want to unwind this trade and they don't want to allow the market to go down too far. Otherwise, they'll be unwinding at lower and lower levels and they'll be losing a bunch more money. So they're just going to want to, ideally for them, and they do have some control and influence over the markets, unlike retail traders, they're going to want this thing to chop sideways. And that is going to be the most likely scenario, at least for another week or so, until they have time, enough times up here at this level to unwind their trades. It may be twice, maybe 3 times, maybe 4 times, maybe 5 times. My feeling is that they've been doing this trade for so long that it could be an extended period of time. It could take 4 or 5 or 6 of these. So we could be chopping for a little while here. And you know what? Would it look so crazy? Would it look so abnormal for us to, starting in, normally we would say October or September, we would start to expect to go sideways into an election. Uncertainty. Now we're just doing it a little bit earlier. We're doing it at the beginning of August and then September, October. It would not be unheard of for us to chop sideways into elections. And that is looking like a very highly likely scenario based on this Japanese carry trade, or institutions to get to unwind themselves and then begin to position themselves for the anticipated candidate to win. And then whoever wins, then you're really going to see the money get allocated into the appropriate sectors based on who wins. Why? Not because of the politics, but the policies that are anticipated to be in place based on what the presidential candidates are running on, the platforms that they're running on. So if we get a Democrat, then we don't expect the policies to change that much. We're probably not going to get a huge rotation or a huge reaction. And then if we get Republican or Trump as president, then you're probably going to see a huge rotation because Trump's policies are very different than the current policies in place. So everything that I'm seeing right now tells me that the highest probability event is a chop sideways, probably between the MA50 and the MA200. Could it go higher to the all-time highs and then chop between the MA200 and the all-time highs? Yes, but that is a lot harder for institutions to pull that off. And harder for, here's why. If I'm an institution and I go, hey, let's bring this up to the all-time high, then we can all unwind at profitable levels. There's going to be one institution that goes out there and say, hey, we just hit the MA50, let's unwind. I don't want to wait till up here. I'm just going to unwind here. I'm okay with the loss or maybe a break even on that carry trade. Just get it off my books. My risk manager is up my butt and bugging me about this. He doesn't want the exposure. I've got the entire risk committee on my case about this carry trade and how much exposure we have. So when we hit that MA50, I'm just going to sell. Then the other institution that was waiting for this all-time high goes, what the hell? Like, we had the opportunity to come off with profit still, but you're selling. I can't get caught on the downside or wait for another bounce. I've got to unwind some of mine too. And so all the institutions start piling on and we start driving this back down. And then they all go, oh, whoa, we're hitting some critical levels here. We don't want to cause a panic and a drop off. Let's pause. Let's wait for some recovery. So very likely that we're going to bounce between that MA200 and MA50. And it's going to carry on at least for this next week. And then we'll see after options expiration, we'll get a better picture on what is going to happen over there. So for the people who are like, oh, they're going to have a huge move one way or the other. What do you define as a huge move? Are we going to break out and make it all-time highs? No. Are we going to break this MA200 and just go full on bear market? Wall Street would lose so much money if we did that. And I don't think they're going to allow it. That Wall Street will not allow themselves to lose that kind of money. So I have pretty high conviction in saying that we're going to chop sideways at least for the next week, maybe the next 2 weeks, maybe all the way until the election cycle, depending on how big our books are, how big of this Japanese carry trade is sitting on our books. I don't know. I don't have any idea how much money is at risk, how much exposure there is. That's why I can't say, is it just going to bounce 2 or 3 times or 4 or 5 times or 7 or 8 or 9 or 10 times? If I had that information, then I would have a lot more clarity, but I don't have a look into every single institution's book. All I know is that we're going to keep on doing this until all the institutions have unwound enough of their books that their risk managers are not hounding them anymore. So I can comfortably say that at least another week, we're going to do that. I can comfortably say that maybe another 2 weeks. And then after that, it really just depends on the size of everyone's books. And I have no idea what that is. So the other thing that is supporting this theory is that the Bank of Japan came out and said, hey, as long as the markets are in turmoil, we're not going to raise rates again. Okay, great. I don't have to panic. I have certainty now. What happens when we start to flow up? Then the Bank of Japan goes, oh, we're right back to the level where we were before we announced the rate hike. I guess the markets are not in turmoil. I guess I'm good to cut or to raise again. And then what happens? Crap. I really need to unwind my trades again. So from just a purely institutional level, but also the likely behavior of the Bank of Japan, this is why we're going to keep on bouncing around in here until that trade is unwound, or enough of that trade is unwound for all the institutions to be comfortable. And so really, this is all that matters right now. This is the biggest risk in the market right now. That's all that really matters. The Fed can make it worse or make it better based on what they do on September. So if they cut rates in September, that makes this carry trade a lot worse. So that's another argument for, in a shadow way, yes, the Fed is beholden to the markets. The markets are anticipating that they're going to cut in September. But if they do that, that's going to be worse for the markets than if they do nothing. But people aren't thinking that way. And so that's the shadow part. That's on the surface. Everyone says, hey, we should cut, we should stimulate. But that's going to be, because of this Japanese carry trade, that's going to be very dangerous for the markets. And so the hidden viewpoint from protecting the markets that the Fed has then is, we can't cut rates right now. Because let's just say on September, what is it, 18th, that they're, yeah, September 18th. Let's do this. Okay. And this whole time, we're doing this. Bank of Japan says, hey, there's no market turmoil. We're still at these levels. Let's raise rates. And institutions go, I'm not done unwinding yet. I mean, I've been doing this trade for like 5, 10, 15 years. I don't know how long. Bank of Japan has had rates at 0 or negative for decades. So I have a huge book, most likely, of these carry trades. And then the Fed also says, hey, Bank of Japan, you just raise rates. I'm going to cut rates. And we're at this level where we still have a lot of these carry trades on the institution's books. That could easily send institutions into panic, more so than this right here, because this was just anticipation that the Fed was going to cut rates. This is the actual fact that the Fed cuts rates. So if they cut rates and we haven't had enough of a chance for institutions to unwind that trade yet, that would cause panic. So that's another reason why we're not going to anticipate a rate cut in September. So I know a lot of other people will have a lot of other opinions and very strong opinions. And for me, I'm just counting on this market chopping sideways. And I'm going to be adopting a very practical wait and see approach, where I'm not going to, yes, I have the strong conviction that this is going to happen, but in terms of actually trading it, it'd only be like 1 or 2 tail risk trades where I invest a very small amount of money. And if it happens, I make a huge amount of money. For the most part, my portfolio is going to be neutral. So if we go up to here, I'm going to make sure that I'm very neutral. Here I can do some directionality, slightly bullish. Once we get here, I am neutralizing. I am hedging. In case I'm going to be positioned as if we're going to go down, but hedged in case we go up. And then when we come back down in here, okay, I'm going to be positioned as if we're going to go up, but hedged as if we're going to go down. I need to be very, very careful in this environment, because a false step, it means a large move. What we have high VIX, we have high volatility, meaning that we can move very quickly. And if it's to the downward direction, we can move really, really quickly. That VIX could spike way up again. So I want to be very, very careful in this environment and just make sure that actually, for the most part, I'm going to be mostly cash, and then I'm only going to have a few positions positioned to either take advantage of this chop in between the MA50 and MA200 that I am anticipating, but I'm going to be hedged or tail risk trades like no tomorrow, just in case I'm wrong and we break out. That's the practical and best way, the responsible way to play this environment, because the risk is elevated. The VIX is elevated. And so far, it's without direction. High volatility with directionality is the equation for huge gains and huge wins. High volatility without directionality is an equation for getting wiped out by randomness, up and down jagged movements. We can anticipate a larger movement in between the MA200 and MA50, but if we allow ourselves to get caught up in the swing up and down in between those levels, then we could get wiped out. So we just need to keep our perspective throughout this entire period and just be really, really careful that we don't get excited, that we don't cause emotions or whipsawing to make us lose sight of our plan and our pattern of how everything is moving out. As long as everything is between that MA50 and MA200, then we are, right? Our plan is perfect. And as long as I'm well hedged in between these levels, when we approach these levels, then everything is perfect. I just have to make sure that a weird whipsaw in between, because we have high volatility, doesn't cause me to lose sight of this picture right here and say, oh, where are we in this picture? If we break down below this, okay, then all bets are off because it is outside of my picture. But if I go from here to here in a single day, I'm not going to panic. That is within my picture. That should have been within my plan. That should be captured within my plan. And I shouldn't see any unacceptable losses because if I executed my plan, this is within my plan. So we just need to keep perspective. Is a drop from here to here, is that a panic? Yeah, you could call it a panic, but it's not a reason for me to panic. It's a reason for me to get my hedges on or make sure I'm well hedged in case we keep on going down. But it is also a signal for me to start positioning my portfolio for a wave up. So I just need to emphasize that because it's so easy for us to, even professionals, and especially news, the people are, if you listen to the news, you're going to get whipsawed so much. Just like this. Oh, we're going to have an emergency rate cut, 50 basis points. No, we're not. No, we're not. And we didn't get it. And what happened? We floated back up anyways. We don't, so don't, if you had traded based on that news and some people were, there's financial gurus who are like, oh, we're going to get we need to do this because of the 50 basis point rate cut. No, it didn't happen. It's not going to happen. We can't be super reactive. We need to have our plan in place and work our plan until our plan is proven to be not relevant to the situation anymore, in which case we need to replan. And actually, we should be updating our plan on a daily basis, just in case we see something that puts it at risk of not being relevant anymore. So really, I'm not looking at the Fed data that's coming up, although there is a lot of Fed data coming up. I don't care what it is at this point because the market has 100% conviction that we're going to get the rate cut. And I have like an 80-90% conviction that we're not going to get a rate cut. So those are two very conflicting viewpoints. And so I'm not going to care about this data, the CPI, the PPI, I think it's PPI, the core inflation. I'm not going to care about that because it's not going to play. Some people say that this market is going to be highly reactive to the Fed news. Maybe if we're saying the difference between this 50 basis point cut and this 25 basis point cut, that could be highly reactive to it. The market could appear to be highly reactive to it because it could jag up and down like this. But if it stays between the MA200 and MA50, to me, that's not highly reactive. That is just playing along the lines of this high volatility environment. Highly reactive would have to be flying through that MA50 or flying below that MA200. That would be highly reactive. Is the data next week going to shoot us above the MA50 or cause us to crash below the MA200? I don't think so. We might swing wildly in between those two, but I don't think it's going to send us directionally beyond those levels. And if it makes it past the MA50, it's going to make it past this peak right here or the all-time highs. No, it's not. So to me, all this movement right here is going to be noise. And so therefore, I'm not going to look at the data right here. All I'm going to care about is, for the most part, is how does this Japanese carry trade look to the institution? And do I need to unwind more or am I okay if I'm an institution? And overall, in the markets, if we take all of the institutions as a single entity, do they need to unwind more or are they good? When can we stop thinking about the Japanese carry trade? Because the Japanese already said they're going to keep on raising rates. As long as they keep on raising rates, then I need to think about that carry trade as long as I have a position. Unless the one thing that might cancel that out is if the Fed starts raising rates as well, because then my carry trade is still okay. If there was a 5% difference between the interest rates, great. Because if they both increase, then I'm still maintaining that 5%. I have nothing at risk. I have risk if the gap closes, and that can close from a single direction from the Bank of Japan, or can close from both directions from the Bank of Japan and the Fed. And so right now we're anticipating Fed is going to do it as well. And if we really think that way, then, for example, if you start seeing this go up to 70, 80%, 90%, 100% on the 50 basis point cut, then we could start to see a little bit of panic. That could cause that as well. So we could see a breakdown below that MA200. So I guess I will look at Fed somewhat carefully, but not super, super carefully. Because for the most part, it's, do I still have this Japanese carry trade on my books? And if I do, then we're still at risk. And there's still the biggest known risk in the market right now. And it outstrips all the other risks. It's by size, it's much bigger than all the other risks. Okay? So this weekly market review, I've focused exclusively on it because really nothing else matters that much. I mean, earnings season is almost over. We do have a few large ones coming up this week, but in light of what's happening in this carry trade, no one's going to care. Institutions aren't going to care. They're going to be too busy worrying about their risk over here on the Japanese carry trade. And then there's a few, right, smaller desks or whatever. They'll still be conducting business as usual, but their volume versus the volume that can be brought to bear for this unwinding the Japanese carry trade is small. So we're really going to be paying attention to the US dollar, okay, the US dollar Japan, and whether or not Japan announces another rate hike, and whether or not the US looks more and more like it's actually going to cut rates. But again, the chances of that, in my opinion, are very, very low, despite what everyone else says. So we'll see. We'll see how it all plays out. Or, maybe this carry trade gets unwound before that September 18th rate decision. And in which case, everything that I said will be irrelevant in terms of, not everything I said, some of the things I said about not getting a rate cut in September then becomes irrelevant if this carry trade is gone before we get there. But we'll see. We'll see how it all plays out. For now, next week, it was really just looking like a wide range chop sideways, which is what we said all last week as well. Okay, so we're well positioned. I need to make sure, I need to go back and look at our portfolios and make sure we're well positioned. I can't just assume that things may have shifted. And if we're not well positioned, you'll be seeing instructions from me on suggestions on how we can position ourselves better. So that's it for today. Hopefully you didn't get bored by all the the Bank of Japan and carry trade talk. That was the only thing we talked about, basically. So have a wonderful rest of your weekend, and I will see you tomorrow.